Hello and welcome to TheoTrade. My name is Doc Severson and this is the Theo Night Report for Tuesday, September 6th. Well, after the Labor Day holiday, today markets started trading again in the cash session and it's just like Groundhog Day again. Now let's look at the landscape for the rest of this month. So here we are today and here is the next big risk event here, which is the FOMC. This is not just any FOMC meeting. This is one of the big quarterly meetings where not only does Janet Yellen issue policy, but then about half an hour later, they trot her out in front of a microphone and she does a full press conference, which usually lasts a lot longer than you would expect. Now, she's gotten really good lately in the Greenspanian method of talking a lot and really saying not very much. Haven't we heard the same thing from her for the last 6 months? Well, everything's data dependent and we really would like to raise rates, and everything's data dependent and we'd like to really raise rates. Well, what happened last Friday with the jobs report where it came in about 20,000 underneath consensus? So haven't we seen this story before? We've heard about this many times where all the Fed heads get out there and jawbone things higher and raise the expectation of raising rates, and then some key number will come in and completely ruin the party. So where we're sitting right now, if we go out to Fed funds futures, if we pull this down here, we can see that right now the probability of a rate hike right now is pretty low, only 18%. Now we've seen this number be actually fairly volatile before, so anything can happen in the next 2 weeks. But I don't see any number coming along to really change this. So right now, traders feel that they have a pretty good handle on what she's going to do. But right now, 18% is not something that they're going to be banking against her raising rates in September. So again, it seems like every time they get ready to raise rates, they're just about to do it, all of a sudden, some kind of trapdoor opens up somewhere. And so the next possibilities for the Fed to do any kind of monetary policy action is the 2nd of November. Really? Do we think that they're actually going to do something the week of or right before the election? I don't think so. And right now the market's showing only about a 20% chance of that occurring, 78% chance of standing pat. So now we get out to December, and this is where we start to see a real possibility, with about 43% of a quarter point rate hike. So what does this all mean to us as traders? Well, it means that there's a pretty good chance the Fed is going to stand away until December, even if the numbers are still pretty good. Because the jobs number last week really, if the Fed is to be believed when they say that they're data dependent, a weak number really doesn't give us confidence that they can do anything. So a rate hike on the 21st, I think, would really upset the market. And since the Fed has sort of taken on this mantle of not only supporting rates and employment, but also the stock market itself, I think there's a very low chance that they do anything at all. So what does that really mean to us as traders again? Well, to borrow a line from Apocalypse Now, I think it means that we still remain this sort of snail crawling along the edge of a razor blade. So this means that as long as nothing really disturbs the market, it can continue this glacial advance to the upside. And I think that we're probably have a destiny with the 2200 number. I mean, we're only 15 points away. That's 1 day's worth of work, right? So let's pop above 2200, get everybody excited. And meanwhile, what we're going to do is we're going to see this linearity drop on the weekly chart to the point where typically it shows exhaustion. So for that reason, I'm not necessarily bearish over the short term for about the next month to 2 months or so, but I'm expecting to see realized volatility kick up. We have got to revert back to the mean. So here's the S&P 500. This is just a daily chart here, and what you're seeing in the orange line at the bottom is the realized volatility. This is the volatility of the price, or some people call this historical volatility. I prefer to call it realized because this is actually what's happening with the price. And what we're seeing right now is it is about as low. It certainly is as low as it's been for the last year, but I mean, this is a multi-year low that we have. This little price movement, this is not going to remain like this for very long. Range contraction leads to range expansion. So what I expect to see is that this will start to oscillate and become much more unstable over the short term, and I think we might be able to hit some price targets. Now, going back to the full SPX, again, what I'm expecting to see is the price kind of pop up above here. After all, there is a lot of energy here on the daily chart. All this non-linear price action, actually what it does is it builds up potential energy for movement. Now, which way is it going to go? Right now, the trend says up, and I think that we pop above 2200, but in doing so, I think we exhaust the weekly chart, and I think it's got no other recourse but then to retest 2100 or some level near there, maybe as high as 2120 or so, to pull this back down. I mean, this is such a common move where we see a breakout above an important level and a retest of that breakout later on before it's able to achieve escape velocity. Now, here's the trade on the Qs that we've been talking about and set up today. So the logic behind this is that the Qs from a monthly chart is coming up on a very important price level here, right around the 120 level on the Qs. If we went over to the NDX, we'd see essentially the same chart. So what we also have is, as we look down at the weekly chart, is we have the same level where we've seen the chart typically have some type of reaction. Again, some type of reaction, like the beginning of 2014 where we saw some type of reaction, right? Every time it's gotten down to this level, we've had some type of reaction here, some type of reaction. This is all I'm looking for. I'm not looking for the Qs to sell off. I'm just looking for the realized volatility to increase. So today we set up this put spread here. This is a long put spread where we buy the 118.5 put for the 7 series, and we sell the trade. We sell the 116.5 put of the 7 series. So again, this is a vertical spread. You can see the expiration graph for this in the green, and the white line is the realized P&L. So really, for max profit at expiration, we would expect to see the price down here at about 116.5. Doesn't seem like it's very much to ask for that we get some type of volatility up and down in the near term. So is it possible over the course of the next 30 days or so till expiration at 7 October, is it possible that the price might be able to come down to that of the short strike and be able to allow us to execute a profitable exit on this trade? So if we look at the option chain for this, it's 7 October. Okay, what we're going to do is we're going to look at these, and the probability of touching for this option is about 78%. So there's a 78% chance that the price at 116.5, that strike price, will be touched at some point for the next, in this case, 31 days of price action. So I like this trade because the reason is because, again, we're not expecting it to do anything. We're not forcing it. If we were setting this up as a way out of the money vertical spread, then we would be forcing the price to go in that direction. But in this case, we're really not. All we're looking for it to do is right now going from the current level of price volatility or realized volatility. All we want to do is to see it start to swing around a little bit more. And given today's historically low realized volatility, the chances of that starting to increase or revert back to the mean over the next 31 days, I think, is very, very high. And the probabilities of us touching that lower strike at the very least is, again, 78%. Now, one last thing as we look at the daily chart of this spider is if we zoom in here on the volume, we can see that the volume actually is really, really low right now. We'll start to see volume creeping back in as we see traders coming back from the holiday, and we should be at full volume and full power in the market starting next week through the end of the year. So strap on your helmets, folks. We're getting ready right now. That's it for today's video. Thanks for listening, folks, and we'll see you tomorrow.